Welcome to the Exit Masters podcast. I'm your host, Jai Waterman, tech CEO at Blockstation. On today's show, we have an incredible guest. Monty Fowler is a seasoned strategist, go-to-market expert, fractional CRO, and has helped multiple startups across many industries take their business to the next level. He's also a three-time founder, dedicated mentor, and his newest endeavor, the author of Executive Debt: Confronting Long-Term Costs of Short-Term Decisions. In this episode, we dive into one of Monty's exits, which was a smooth 9-figure exit, and some of the strategies that he used in order to achieve this outcome. One thing I know from talking to many entrepreneurs is exits are not smooth. So if you're planning to have an exit or you're guiding other entrepreneurs through this process, I highly recommend you listen to some of the strategies implemented by Monty in this episode. Welcome, Monty. Let's get into it. Tell me a little bit about your background story.
Oh, wow. That's a great story. My career actually started after I got off active duty in the Army. I had opportunity to work as a network engineer. I had no experience. I basically got on-the-job training. The consulting firm I was working for put me in at their client facility for one of the top 10 architecture and engineering firms in the country. This is in the early 90s. I learned all about how to build networks, and I even moved into 3D modeling and animation.
You were lucky to have that on-the-job learning. From there, you pivoted into software sales. Is that correct?
I had the opportunity to go to work for a software company called Data, and I started my career in software as a solution engineer, basically teamed up with a couple of account executives, and I was the guy that did the demos, connected everything for the pilots. I complained one day about my compensation on a really, really big deal that I had spent months driving back and forth from Chicago to this client, making the deal happen. And I was going to get like a $10,000 bonus, and my sales rep was going to make over $500,000 commission on this deal.
So you're grinding for months and somebody else is making all the money. Is that the kick in the ass that kind of put you into a different direction?
It really just chapped my butt, man. And so I said something in front of our VP of sales, and, in his nice Texas drawl, he looked at me and he said, "Well, hey buddy, if you don't like the way you're getting paid, why don't you take your skirt off and go into sales?"
That's a wild story, man. So I'm guessing you probably took the leap?
Now, this is the late 90s, so you could still say stuff like that at work and not have HR called on you. But I thought about it for a while. I talked to my wife and went back to the VP and I said, "I'm interested in what your offer, but here's what I need." He made a couple of phone calls, made it happen. But that executive, he turned out to become my mentor. He saw something in me, I guess. And then we really developed a close friendship. And then we started doing missionary work together in our off time.
Well, that type of relationship is rare.
His name is Steve Connor. Steve and I have worked together over the last 25 years at 6 different companies together. I learned the value of having a mentor. Steve brought me into my first startup. He called me up and he said, "Hey, Monty, I got this new startup down here. I'm going to send you a plane ticket. I need you to help me do this thing. We're going to make good money and we're going to build a great company." And I was like, yeah, I'm not leaving Data, bro. But I accepted the ticket. I went down and I saw it. As soon as I met the co-founders and saw what the solution was, I was all in. And he told me, he's like, "Hey, I can pay you half of what you're making right now."
That's the bet, right? Give up immediate gratification for a long-term payout. Most people aren't willing to take that bet.
I ended up with a sales rep salary anyway, but I went down and we did that. The company was called Evity. We were in the market for about 18 months. We got some marquee clients and we sold the company to BMC Software for $100 million.
Oh, nice.
And there were 23 of us in the company. So everybody had a very good exit. Some of us had, kind of, I wouldn't say life-changing money, but trajectory-changing money, we'll call it.
18 months, a small company, only 23 people, $100 million. I love it.
That planted the seed for an absolute fascination with startup environments. I'm on my 9th startup as a founder / early stakeholder. And I've consulted with probably 24 other startups over the last 25 years as well. I love founders. I love early stage. I love the controlled chaos of a startup environment. I like the creativity and the problem solving and the wearing a lot of different hats. I'll never forget in our first startup, this is back in the days when you would still run print ads for software, right? It was a long time ago. We had just gotten our angel funding and we were going to run our first big ad in Network World magazine, which was like the premier publication back then. We were trying to decide on what the imagery was going to be for the ad. And I'll never forget that the entire engineering department, the sales and marketing team, and our two founders huddled around a little 13-inch monitor, picking out what image was going to go into that ad. And that's like the quintessential startup moment that's like seared into my brain forever.
You know, some of the startups I've had in the past, it's like when everybody cares, and it might seem like almost nothing at the time, but it's such a critical decision. It's such a cool time. That's startup gold.
Because that represents exactly what a startup is. Every decision is consequential. Everybody should care about it. And even the smallest decisions matter in the long run. That ad is what the NA person at BMC saw, which caused them to go to our website, which caused them to call us and have some meetings. And within 3 weeks of our first meeting with them, we had a term sheet for them to buy the company. So it's pretty wild.
We talked about your roles as an IT guy, and then you transitioned to sales of the software, and you went into the startup world. When you're building out software, we always build up technical debt. When you're trying to roll out features for your customers, you're going to take some shortcuts. This technical debt builds up and you're going to have to deal with it eventually. Technical debt, we hear this term all the time, but can you explain to us more about what executive debt really is?
Yeah. So I was having a conversation with my partner, Mark, and he was working with a client that had a stack of technical debt, and it was really impacting all the other aspects of the business. It had become like a boat anchor around the growth of the business. And he goes, damn it, I'm so sick and tired of talking about technical debt, but we never talk about executive debt. And as soon as those words came out of his mouth, it was like fireworks going off in my head because I knew exactly what he was talking about, but I'd never heard those two words together before. This led me to go do some research that evening. Surely somebody has written a book about executive debt. And I found that nobody had written on this topic in the way that we had kind of framed it. Technical debt, as you know, that's a well-trodden path, even though everybody still struggles with it. We've stumbled upon a greenfield area of thought leadership. Maybe we should write a book about it. I'm an author already, so I wasn't necessarily terrified by the prospect of writing a book. And anyway, wrote the book. We published it last November. And since then, it's really been kind of the centerpiece of our conversations with the marketplace. So executive debt is really, I consider, a superset, of which technical debt is one of the components. It's one of the most visible components because it's really easy to see. And many times it impacts things that affect our downstream customer, which we hear about through our support line. But executive debt is fundamentally different. This is the debt that accrues at the very top of the organization, right? When executive leaders get together and they make big strategic decisions, and this has been my personal experience as a consultant, you walk into a room and the dynamic is this. We've got an agenda. We're going to talk about a bunch of stuff. One or two topics tend to dominate the entire conversation. And one or two of the strongest personalities in the room tend to dominate the ideation. And ultimately, people align with one or the other and vote or abstain, and a decision is made. Very little data is used. We're certainly not looking back at our previous strategic decision sessions and the outcomes of those decisions.
So what do you think keeps executives stuck in this type of mindset?
We typically focus on what is the shortest route to the easiest gain we can get from this decision. How can we make a decision that's going to yield a short-term benefit? Because we're really just talking about something that's 2 quarters away. That is just the complete wrong way to make strategic decisions. And what we found through our research is that this racks up all kinds of debt throughout the organization. It impacts, obviously, your strategy. It impacts your culture. It impacts your operations. And ultimately, when all of those things are happening, it impacts your people, your talent. And so we wrote this book that helps people first define and understand what executive debt is. Secondly, identify where it exists in their organization. And third, how to start the process of mopping it up and retiring it like we do with technical debt, right? And honestly, we don't teach this in business school. We don't reinforce it in our MBA programs. We don't teach it in our training inside of our companies. And very few people have a mindset that is naturally orientated toward the future. I grew up in a really big, loud Italian family. And I think there's something in our DNA that allows us to picture the worst possible scenario for any given set of circumstances, right? I mean, a million different things we can imagine will go wrong. And that's super helpful because then inevitably something does go sideways and one of us has already thought about it and planned for it and we We just handle it in the moment. That's exactly the kind of person or persons that we need in the boardroom when strategic decisions are being made.
If you talk to a financial advisor, one thing they always say is that the future outcomes are not necessarily going to be the same as what we had in the past. We always have to be looking forward as to what we believe is going to happen, not only based on the historical data, but also what is coming down the pipeline. For example, any organization, e-commerce business who is not taking into consideration AI, well, I don't think you're going to have a future. So it's not just about making sure that we meet next quarter's results. We need to make sure that we're making the decisions for next year and the future to come. Now, that's one thing about startups is we have to continuously be aware, be ready to pivot, be ready to adopt, because that's the reality of the world that we live in. By thinking ahead and planning ahead in the right way is powerful.
The decision we're making today through the lens of the future and say, okay, guys, here's our plan. Sounds great. Love the outcomes we're aiming for. But what if? What if these are the types of questions that should be asked when we're making strategic decisions? But if you don't pay attention to it, these are the things that wreck companies. And when we're talking about the VC community and we're talking about how do you prepare companies for exit, these are the things that drive due diligence right into the ground, like a lawn dart.
Unfortunately, companies could be doing amazing, getting great traction, sales, but when they hired people on, did they take care of their intellectual property and have the right contract signed? Are they keeping their accounting up to date and doing their reconciliation, or are they going to be trying to figure out some transaction from 3 years ago? All of these things matter, especially for the risks, because most companies, in my perspective, go out of business because they haven't thought about the different risks. As you said, all the what ifs. Document the risks and document the potential mitigation and score them. This is what any proper enterprise risk management system has, a way of measuring these different risks so that you know if this is a risk that you can prioritize and determine if you're going to do something immediately or if something can be, pushed out till next year, not considering risk that's going to create a train wreck with their business.
That's why it matters at exit, right? Due diligence doesn't just expose financial challenges or engineering challenges or even people challenges. It really needs to reveal the flaws in the company's leadership system. That's when you'll find out whether it was luck, whether it was lots and lots of iteration with a lot of broken glass on the ground, or whether it was really high quality, well-considered decision-making with a systematic approach to it. And that's what I think smart VCs today and smart, underwriters are looking for is, I know the numbers are good, but can you quantify the system that got us to the numbers? Because if there isn't a system, when a company changes hands or when a company, IPOs and big inflow of cash, lots of new people, if your system isn't baked already, you have more of a chance of breaking whatever is good than enhancing what's there.
That's because they don't have the right processes and procedures in place in order to scale. A small organization doesn't necessarily scale when you're bringing in this influx of new blood, new people, new brains, new products. What I find though, you have some organizations that are really good at iteration and try and fail and adjust. And then you have some companies that get stuck in that strategy and planning phase. I'm going to use development for an example. You've got a development team and you got the architects and engineers, and these are all smart guys, PhDs, and they plan out this whole thing. And when they try to implement it, it's a complete failure. But if they just tried and failed and then adjusted based on that, they would have got a result much faster. So I'm curious from your perspective, what is the right amount of planning and strategizing versus going out, trying, failing, and getting some broken glass on the ground?
Sure. Well, Jeff Bezos has a great take on this, right? So he is all for what you just described, that startup mentality of, fail fast and break things and we'll learn quick and we'll get to the right solution faster that way. And you learn an awful lot while you're failing. That's great for what Jeff Bezos calls two-way door decisions, meaning these are things that we're doing that if we get it wrong, we can undo it really fast. And it has very, very little impact on anybody outside of that organization. And that's exactly what a really healthy development team looks like, or engineering team looks like. Quick sprints, they're learning a lot of stuff. A lot of it isn't working, but every time we iterate, it gets better and better and better. When you get to what Bezos calls the one-way door decisions, that's the decision like starting a new region in Europe, for your sales organization, right? You got to hire people. You've got to put, marketing resources on the ground. You've got to do some rebranding. You definitely got to do some localization. You got to spend a lot of money and make a lot of plans in order for that to come to fruition. And a lot of those things that you have to do and build are really hard to unwind. And if you do have to unwind them or shut them down, it's going to have a really negative impact on all the adjacencies within the business. And I've seen this happen firsthand. I've seen global expansion fail and seen the wreckage that it has for the sales organization and marketing. And then that has a cultural impact on the company because now it was like, oh, we were going to do this great thing. Oh my gosh, we actually suck at that. And all of my friends just got fired. What does that mean for me? So those one-way door decisions need another level of clarity and diligence and time in order to make them well. A good example is the aerospace industry. And there's other industries that are like the aerospace, but I'll use them because everything that is built in the aerospace industry has the potential to kill people. Airplanes, rockets, munitions, all that stuff. If they get it wrong, somebody could die or something really expensive could end up on the ground in a flaming heap. You go to someplace like Boeing. They might not be the best example right now. Let me pick a different one. Raytheon, go to Raytheon. And they're building drones, right, for the military. Every single part that goes into that device goes through a process. And they always ask what if questions at like every major step along the way. Because if that thing fails, not only is it catastrophic, but they have to have a system in place and the data in place to be able to walk back that decision in the timeline to figure out what actually failed. Because the systems that they're building are so complex. That's the stakes of that segment of our economy. They have figured out how to do this. And that's why errors like that are so few and far between. But in business, we do not employ anything even close to that. And when you think about it from a capital perspective, think about how much capital is deployed in startups that never yields any return or value for anyone. It's literally money that we set on fire, right? And much of that is driven by people at the top sitting in a room making bad decisions with bad information with no system.
I'm kind of obsessed with systems and processes and procedures. And that came from a pain point of trying to run a business a long time ago. We didn't have the right systems in place. We just couldn't keep up. We couldn't actually grow. With Blockstation, one of the stock exchanges wanted to do a stock audit on us. And so they hired EY to do this audit, and EY going through our processes and procedures and risk management and our measures. They were astonished at how interconnected all of our systems were. And that's because of all the experience that I had struggling with different businesses and not having systems, becoming obsessed and putting those systems into place. So, I completely agree how important those systems are as part of the decision-making process, because that in itself is supposed to be part of a system. I'm curious from your perspective for startups and even well-established companies, what type of systems do you recommend that they utilize so that they don't build up all this executive debt?
Great question. Most businesses, we have our CRM, we have our financial accounting system. And then if we're a SaaS company or a software company, we probably have a back-end platform that we can look at, that tells us about our clients. But that's it. Really, it's about the communication and the conversation that happens between the decision makers in the room that really matters. And the beautiful thing is that AI and that generative AI technology and agentic AI, every company from a solopreneur to the largest company on earth has the ability right now with the tooling available today for little or no money to be able to utilize every bit of information that's available to them to help inform a decision.
As we get closer to the end of the year and companies start budgeting for next year, planning their annual projections and their growth, that's, typical. Is there something else that companies should be doing to be able to plan effectively for 2026?
Let me give you an example. We're a software company. We've been killing it in the US, and now we want to go somewhere else. Europe looks like the perfect candidate. Great. So we start laying the tracks. We start deciding what countries we're going to put people in, where we're going to have our call center, how are we going to market, yada, yada. Most companies will make that decision with a little bit of data, and let's be honest, that data is probably irrelevant because the North American market is fundamentally different than the EU. We make these decisions with very little information, with a lot of bias, with a lot of history from each of the executives in the room. Maybe they've worked in Europe before, they think they know this or that, and all that gets thrown onto the table when we make a decision. What we should be doing is looking at, when's the last time we created a new territory? When's the last time we created a new regional focus in North America? And where's the data? Let's pull up the Zoom meeting conversation transcripts that we had. Let's pull up all the CRM data. Let's pull up all the information relative to the decision after it was made. What does our performance look like after we moved into that region? And let's feed all of that into AI. And then let's tell AI, here's what we're contemplating. We want to go to Europe. Take all of our information from our past 3 regional expansions and feed that in and use that as your basis of knowledge and tell us what we should be thinking about before we decide to move into the EU. If we just did that, we would make like 90% better decisions and consider more of the downstream impact before we pull the trigger. We have the ability to do this now. We're coming into the end of the year now. A lot of strategic decisions are going to be made. What's our revenue goal going to be? What are our territory goals? What's our individual reps quotas going to be set at? How many companies are looking at the last 3 years of the decision-making process, all the conversations we had about setting those goals for the last 3 years, all of the CRM data before and after we made that? How many are feeding that in to AI and asking it for a recommendation for next year? And you can even tell it, I want you to look at the last 12 months of Wall Street Journal and HBR articles on strategic planning for 2026 and beyond, given the current economic climate, blah, 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 blah. Every company has the ability to do this right now. It simply takes one leader that's in that room, one person brave enough to do that in a boardroom. It changes everything.
That really hits home. The difference between the culture in New York versus Miami, very different. If you go into Europe, whether it's Hungary or Czech or Romania, again, cultures are very different, I would say. Different risk tolerance, different opinions on the blockchain and how things should work. On this one stock exchange world tour that we went on, only one exchange was like, no, we don't want anything to do with blockchain, which was very interesting to me.
The EU is not created equally. Right? If you want to do business in the UK, you're going to do it fundamentally differently in Portugal. And if you're going to France, well, there's a whole bunch of other stuff you need to know about. And those things are real, and you ignore them at your company's peril. It will cost you millions of dollars and a lot of shed tears because you'll actively damage your brand. And that's the weird thing is like, if you don't do it right in Germany, you'll damage your brand in the EU, period. This is a story. I mean, I lived this, and it's unfortunate because the person that they hired was an outstanding sales rep, but he did not understand the German market or the Austrian market. And as a result, he was a fail.
Monty, let me ask this. So obviously you've got your go-to-market, you got your expansion, you got your day-to-day and your executive planning. But within that, in your world, exactly what is it that you do in order to plan for the exit or set up things structurally so that when it's time for the exit, it's a smooth process, the way that you explained with that amazing $100 million exit that you had in the past?
So again, it goes back to my very first startup experience. And I don't even know whose idea it was necessarily. But anyway, we had, from the minute we got our seed funding at Evity, and our exit strategy was to get acquired. So whenever we made a significant change to the business or even a moderate change to the business, we documented it in what we called our Blue Book. And the Blue Book had one function. Should somebody walk through our door or call on the phone and say, hey, we're interested in talking to you about an acquisition, we could just dump this Blue Book on them and it would have like 90% or more of the due diligence they would expect from a startup. And I'll just tell you something. One of the reasons we were able to extract $100 million from BMC is because they had never seen a startup of our size with that level of detailed information at the ready when they came to the table. And that's one of the things that I preach to all of my founders, whether I'm their employee or whether I'm a consultant, is where's our Blue Book? And beyond that, though, I think you also need to adopt systems thinking as early as possible. It's super, it's super easy to do in your engineering ranks, and that's where most companies start, right? Because if we're talking software, everything begins with a product. But when it comes to building out the other functions of the business, with the exception of finance, it's usually just a jazz. Everybody's just playing jazz. We're just doing our thing, right? And I would argue that you need sheet music. It's okay to play jazz. You want them to play jazz, but you need to have a melody, right? And everybody needs to know kind of where their part is and how to get back to the main theme. And when you've got a company set up like that, it's really easy to not only grow effectively, but also when the exit opportunities come, you're ready to have the conversation. And to your point, you look different than anybody else they've talked to recently at that stage. And here's the thing, it's an easy win for founders. Adopting systems, I would argue, is easier than everybody playing jazz. Right. And having a book with all of your due diligence documented and regularly updated, like on a monthly basis, like when you close the books, update the blue book. That is an easy win. That's a tiny little thing that you tack onto your CFO or your controller's job. Just say, hey, you're going to keep this set of information updated and at hand in case we have a conversation with somebody.
What exactly lives inside this blue book?
All your typical due diligence that either an underwriter or a VC or a PE firm would want to see. All the financial data cut every which way from Sunday, detailed executive summary of your solution, how it was built, what your tech stack looks like, an accounting of any executive debt, an accounting of any open source software frameworks that you're using in the product, your financial management plan and your governance model, corporate structure. When somebody asks, why not just have it ready? Why go through the fire drill?
We got this amazing story from you about your entrepreneur. Do you have one that didn't go so well that you learned a lot from?
Yeah, I have a failed exit story. I went to work with another very good friend of mine. He's on my team here. His name is James Trotter. He hired me into a company called Interwise back in, I want to say 2008. It was a competitor to WebEx, enterprise grade, aimed strictly at the largest enterprises. It had a lot of features that you wouldn't see in other products for another 10 years or so. Shortly after I joined, the company got acquired by AT&T. And it was a small acquisition, $25-30 million. And we were about 70 people in the company. And it was an interesting thing what AT&T did. They were like one of the largest resellers of WebEx at the time. And they realized that instead of getting this 15% uplift on these licenses, we could have our own technology and get an 80% margin off of it. So that's why they bought us. They rebranded the software as AT&T Connect, and then we were literally swapping out WebEx licenses for the AT&T Connect product. All of us who were leaders coming from Interwise, we now got big teams, big budgets, and $1 billion chunk of business to go run for AT&T. It was an interesting proposition, but it was so flawed in its execution right at the moment where it should have been 10xing for AT&T. And we should have been just killing it, but we weren't. Because instead of riding the WebEx train into every company in America to have the conversation about the even higher quality unified communications and being able to grab their teleconferencing business and their web conferencing business and all of that, they were so focused on making this little $25 million investment into something big that they missed the forest for the trees. Now, for those of us that were there, it was like hitting the freaking lottery. It was like driving around picking up bags of money on the side of the road. I mean, my reps got paid commission on stuff, on deals that they didn't even know about because people were selling our stuff and we got paid on it. But it was an awful experience because that was just an example of one executive trying to solve one very discrete problem that upset the apple cart for everybody on $1 billion chunk of business. So
you end up getting a good exit to AT&T, $25-30 million. But instead of capitalizing on the timing of the market and the momentum, you guys kind of shift gears and the opportunity slips. Did I get that right?
Yeah. I mean, at the end of the day, the executive VP of the unified communication business thought he was going to win by displacing WebEx with AT&T's own homegrown version of the solution. We just missed the opportunity altogether. And you know, at Interwise, we were just trying to get deals with some of the bigger enterprises, right? The technology they bought was fantastic. It could have been a WebEx killer, but AT&T just didn't think about it the right way, right? After about 3 years, everybody who had come with the acquisition was pretty much gone. There's 4 or 5 guys that have stayed there the whole time. They realized, I'm on an aircraft carrier. After you're here 2 or 3 years, your comp plan is so rich, you don't want to go anywhere else. And I validated that. I mean, I'll never forget my first commission check that I was going to get. And I remember calling my wife. I'm like, honey, I'm looking at the system here. I'm going to get a $90,000 commission check this quarter. She's like, that can't be right. And then the next quarter, I got another even bigger check. And oh my God, this is unbelievable. But I hated every minute of it because it was a soul-crushing environment. I can't speak to all of AT&T, but that particular team, nobody was interested in your creative ideas. Nobody wanted to hear your thoughts. And for a guy like me, that was like a sentence in prison.
Speaking of soul-crushing environments, I could see how that would be a really difficult thing to go through. At the same time, it could have been part of what helped to kind of shape you into the diamond that you've become. It's great to see leadership from a very successful and well-executed standpoint, as well as from the failure standpoint. What stood out to you as something that's really made a major impact on your life or an impact on somebody else's life as a result of the work that you've done?
When I think about my career, and I've been doing this now almost 35 years, the things that I remember the most are the people. These are people who were ahead of me and helped develop me, and there's people that I've helped develop as well. We have a responsibility for somebody who's younger than us to help them come along as well and give them our wisdom. The most recent experience I've had was at a startup called Lob in San Francisco. I started there in 2019. They just closed their Series B. So I came in, I started building out the sales team, and one of my folks on the team was our revenue operations person who had been there for 6 years at the time. She had a lot of institutional knowledge. She was very, very crazy smart, amazing worker. And honestly, it was my first experience working with largely all millennials. The founders were millennials. I was the oldest person in the company by about maybe 20 years. And maybe a month in, I get called into HR and she said, hey, this person has brought to our attention that, your leadership style is X, that's not our culture. And I was like, oh my gosh, that's the last thing you want to hear, when you're a middle-aged white guy. I'm a Gen Xer, just to be clear, I'm not a boomer. Anyway, So we have this meeting, and that really impacted me because the thing she was telling me was that my style was a little bit too direct, and it really, really, really hit me. The generation gap, she works in advertising in an office with middle-aged white dudes all day long. I was seeing what she was feeling through my daughter's eyes, and that really, really hit me hard. Long story short, we worked out, and I acknowledged and apologized, and God bless her. That relationship turned into a great friendship, and we still are in communication today. We certainly exceeded my expectations, and I know that I exceeded hers. It was just a problem of perception. But as a result of that relationship and the work that we did together, I was a very successful leader in that company, and it gave me an absolute masterclass in how to work with younger generations that has served me everywhere I've been since and continues to pay dividends. And honestly, it helped me understand my own kids a little bit better because I just have a different way of approaching people of a certain age because I understand what they need.
Communication is so critical. Years back when I was a CTO and I used to manage a development team, I would spend a lot of time putting together documentation, spend hours and hours going over that documentation, what has to be built, et cetera, et cetera. And at the end of the day, it was very difficult for them to follow my documentation. It doesn't matter how good I made that documentation. Just different people sometimes think different ways. A lot of times developers speak a different language. Then I learned later on that if I instead do a sketch, which will take me probably a tenth of the time, I could have such a short meeting and everybody would get it. And everybody would be able to follow. And that would save me so much time and we would get such a much better result. Obviously, AI is changing the face of everything that we do. It's being implemented and injected into basically everything that we do. How is AI going to change the way exits happen? And what kind of impact is AI going to have on the future of exits?
The challenge that we see with AI right now today is everybody's using it. Nobody's managing it. Unlike any other technology that's come around in my life, AI is percolating up through the bottom. I talk to founders and CEOs every week now. How many people are using AI in your organization? I don't know. I know that we have AI tools, but I don't know what tools they are. I don't know who's using them, but I know that our finance person is screaming bloody murder because we've got $10,000 a month of expense charges for this tool, that tool, this tool, that tool. The fact that now people are taking these tools and they're connecting them into our CRM and into our call recordings and into our SharePoint, and they're throwing all kinds of documents and data into these public LLMs, and we don't really know anything about it. And I say this to every founder and CEO I talk to. You need a data governance and AI governance model yesterday, because this is a real present and dangerous risk for every company out there. If one person in your organization has got ChatGPT or Claude, and they've got it connected to your SharePoint or to your Google Workspace, and that has access to your stuff, your data is exposed. And a lot of times it's customer information, customer contracts and IP and your internal IP. It's getting fed into these LLMs willy-nilly. Nobody knows about it. And that is a material risk to your business. That's my big scary diatribe for this podcast recording. My cautionary tale. The speaking to any VCs or PEs that are watching this, every one of your portfolio companies needs to have a data and AI governance policy today. And every founder out there or CEO that's listening, you need to get a handle on this like right now.
In the future, when it comes to an exit, the acquirer is not just going to be looking at your financials and your business plan, etc., but also be looking at how you used AI. Did you expose our trade secrets? Have you opened up yourself to different vulnerabilities the way you're using AI? These are the kind of things that companies are going to have to look forward to in the future, because I don't think most companies are ready for that line of questioning.
Correct. Because and I would say that as of today, it is a critical element of your exit strategy and your due diligence. And in 6 months or a year from now, it will be an irreplaceable or unavoidable part of that. And the firms that get a handle on it now are the ones that are going to do better than the other folks.
At Blockstation, when we started embedding AI in our technology, we actually developed AI governance as part of our ITGCs. A lot of companies are not necessarily tech companies. I guess it would be a good strategy to make AI governance just part of the general overall governance of the organization. I think that makes a lot of sense.
And like cybersecurity, if you roll the tape back 10 years, your SMBs, your SMEs, they didn't have cybersecurity. They didn't really even think about it until some prominent small and medium-sized businesses had a problem. And today, everybody's a target for a hacker. Doesn't matter how big or how small you are. So everybody has to think about cyber. And so the marketplace has figured out how to deliver cybersecurity services to any company that needs them. Elements of interacting with AI, tracking AI, securing AI, auditing AI, that's all fresh territory for creative service providers to figure out a way to do that.
I appreciate the angle and perspective that you're bringing. It's different from the typical playbook that we hear. And I think that the concept of the executive debt is really going to resonate with a lot of our listeners.
Yeah, I would just tell, any founders or VCs, private equity folks that are listening to this, these topics really, really matter. Executive debt is real. And I'm making it my business and my company's business to help mop up as much of it as we can. So if you go to our website, aspire6.com, you can find a link that'll give you a free ebook copy of my book, Executive Debt. I encourage you to read it. If you're a director level or up in a company, or certainly if you're a VC investor, private equity partner, within the first chapter, you're going to go, oh my gosh, I've seen this movie before. And then get busy fixing. And if you need help, we're there to help. But honestly, a lot of the stuff can be mopped up yourself. We're happy to help. We also do workshops for executive teams. We'll even come in and help facilitate your strategic planning process with executive debt in mind. And we've got some other stuff cooking as well. We've got another book coming out early next year talking about the new executive debt threat vector around AI. So look forward to that.
If you're listening to this and leading a company, here's the bottom line. Executive debt can cost you the exit that you're building towards. Start now. Build systems, ask better questions, and treat your AI and your executive decisions with the same seriousness as your financials. Big thanks to Monty Fowler for sharing generously. Go pick up his book, Executive Debt, at Amazon.com and connect with Monty at aspire6.com. And let's continue the conversation in our boardrooms. Monty, that was gold.
It was my pleasure, Jai. Thank you so much, man.